What's up everyone, welcome back to Trader DNA. Today I'm about to blow your mind with the ultimate beginner's guide to the break and retest strategy. And trust me, this is a game changer. This strategy is insane. It's one of the most popular trading strategies in the world, and for good reason. If you've been struggling to figure out how to trade, this is what you've been waiting for. But wait, there's a catch. It only works if you do it with laser focus and discipline. No discipline, no gains. Simple as that. So stay tuned, because I'm about to give you the step-by-step blueprint to crush it in the markets. Let's get started. The very first thing you need to know about the break and retest strategy is the foundation of market structure. And guess what? It's built on three simple phases: an uptrend, a downtrend, and a sideways moving market. These are the basic building blocks of trading. If you don't know this, you're already falling behind. So pay attention. Here's where it gets tricky. The way these phases appear in the market, it's all over the place. Sometimes it's super obvious, other times it's sneaky. That's why it's crazy important to learn the different patterns and movements you're going to see with this strategy. Recognizing these variations is the biggest key to crushing it with the break and retest method. Now, let's break down an uptrend. What usually happens is the market pushes up, pulls back a little, and then boom, it climbs even higher. Then it repeats. Pull back, push up, pull back, push up. It's like the market is climbing a staircase. Super satisfying, right? But wait, here's the catch. In a perfect world, the market would always look this clean and predictable, but that's not reality. Sometimes it'll push up, pull back, and then nothing. It just stalls. Then it pulls back again, and only later does it decide to go higher. This back and forth, unpredictable movement happens a lot more than we'd like, and it can seriously throw you off if you're not ready for it. That's why you have to understand the difference between clean, smooth market behavior and messy, unpredictable patterns. Spotting these differences is crucial if you want to make the right trading decisions and avoid getting caught in the chaos. And here's the bottom line. With the break and retest strategy, your main focus is on finding clean price action. That's where the magic happens. Clean, structured movements make it so much easier to trade confidently and make smart, profitable decisions. The next big step in mastering the break and retest strategy is learning how to monitor price when it breaks above a previous structural high. This is where the magic happens. So pay close attention, because this is fundamental to understanding trends and how the market works. Alright, imagine the market is pushing upward and breaks past a previous structural high. Then, that becomes your new structural high. But wait, you can't just jump into the market the second it happens. That's a rookie mistake. What you're looking for is clear proof that a trend is forming. And how do we get that proof? By waiting for price to break above the structure, come back down for a retest, and then continue to the upside. This is the key sequence that makes this strategy powerful. Now, today we're going to focus on how to spot the best trading opportunities at these break and retest levels. For example, in a downtrend, you'll want to look for clean market structure showing a clear downward movement. Watch for price to break below a previous structural low, come back to retest that level, and then continue its downward momentum. The same logic applies to an uptrend. You're waiting for price to break above a structural high, retest it, and then push even higher. These moments are golden for spotting high probability trades. And here's the cool part. We'll break down the exact patterns you need to look for later in this video. Now here's something you need to know. The market creates structure with higher highs and higher lows in an uptrend and lower lows and lower highs in a downtrend. This is the basic building block of price action. Most of you might already know this, so I won't go too deep into it. But if you're new to these terms, don't worry, I'll simplify it for you. There's something super important you absolutely need to understand if you want to succeed in trading. The only markets you should ever trade are the ones with a clear direction, either pushing to the upside in an uptrend or to the downside in a downtrend. These are the golden moments where your trades have the highest chance of success. But if the market is moving sideways, if it's stuck in a boring consolidation or a tight range and you can't spot a clear trend, here's what you do. Nothing. Yeah, you heard me. Do nothing. Don't trade it, don't force it. Why? Because trading the market without a clear directional bias is just asking for trouble. Now, here's the mistake so many traders make. They start creating stories in their heads about where the market might go. Stop doing that. That habit leads to all kinds of bad decisions, like taking low-quality trades, losing money you didn't need to lose, and chasing setups that just aren't there. And you know what that leads to? Frustration, losses, and worst of all, bad habits that can wreck your trading. So here's the bottom line. If the market is moving sideways, do not trade. I mean it. Stay out. Only trade when you see a clear, undeniable trend, either up or down. This discipline is what separates the successful traders who crush it in the long run from the ones who consistently blow their accounts. Stay focused and trade smart. The next big thing you absolutely need to understand is the different phases of the market. Why? Because these phases are the roadmap to spotting the best trading opportunities. So here's the game plan. We're going to focus on identifying what's called the exhaustion phase, then recognizing the exact patterns we need to spot, and finally entering trades in sync with the trend, whether it's moving up or down. And when we do this, we enter what's known as the continuation phase, aka where the magic happens. Now, when the market is trending up and making those big, beautiful pushes to the upside, that's what we call a continuation. It's the market moving with the trend, climbing higher and higher, and giving you those amazing opportunities to ride the momentum. But when the market starts pulling back, when it takes a breather or dips temporarily against the trend, that's the exhaustion phase. And this phase is critical. Why? Because this is where the market gathers energy for its next big move up. Here's the deal. Your job as a trader is to spot these exhaustion phases and know exactly when they're ending. And guess what? Once the market shows those clear signs that the exhaustion is over, boom, you're going to jump in on the continuation. But wait, you can't just dive in blindly. You'll need to recognize the specific patterns we're covering in today's session. Once you see those patterns, that's your signal to enter the trade and ride the trend to the upside like a pro. Now, the same rules apply when the market is trending down. When it's pushing lower and making consistent moves down, creating those lower lows and lower highs, that is your continuation phase in a downtrend. But when it starts pulling back against the trend, when it pauses and moves slightly higher for a bit, that's your exhaustion phase. And this is where the action happens. You want to look for the patterns we're discussing today, wait for the exhaustion to finish, and then take your trades as the market resumes its downward momentum. So, to wrap it up, your mission is to master the difference between the exhaustion phase and the continuation phase. Once you understand how to spot these phases and the patterns that come with them, you'll have everything you need to time your trades like a pro. Whether the market's trending up or down, you'll know exactly what to do and when to do it. Let's get into it. In the simplest terms, what you're going to be focusing on is spotting that exhaustion phase. Why? Because once you spot it, you can stay ahead of the game and start trading with the trend when it kicks into that continuation phase, the phase where the market pushes forward again. This is where you'll find your trading opportunities and ride the trend to make some serious gains. Now, let's dive into 2 key patterns you need to be looking for as part of this break and retest strategy. These are the patterns that will help you trade in sync with the trend, whether the market is pushing up or down. Quick recap. You're looking for the market to pull back, create an exhaustion phase, and then look for the perfect moment to enter after it shows a retest of the previous structure. That's when you can take the trade and get on board with the trend. Once the market shows you that the exhaustion phase is complete and it's time for a retest, that's when you jump in. You're going to ride that next move in line with the trend, entering the push phase as the market continues to move down if it's a downtrend. This is how you lock in your profits, by riding that continuation after the exhaustion. Now, when the market is pushing to the upside, you're going to wait for a break above the previous structure, followed by a retest at that level. When the market pulls back and hits that exhaustion phase, you'll see the patterns we're talking about today. Then you'll take your position and trade in the direction of the trend, waiting for that push phase to continue moving up. But, and this is key, if the market starts moving sideways and you don't see a clear direction, whether up or down, then you do not want to trade. Sideways markets are the ones that'll throw you off, leading to confusion and losses. You need clear trends to make this break and retest strategy work, so stay out of the sideways action. Alright guys, here we go. Pattern number 1. Let's jump right in. First things first, take a close look at this part of the chart. Now what we're doing here is zooming in on this specific zone, and you can see it, right? Boom! We've got a big strong push to the downside. But wait, where's this coming from? This move is happening right after an uptrend, which means the market was climbing higher before this pullback. But now, as it dips back down, we call this phase the exhaustion phase. Now, what does that mean in simple terms? It's like the market is hitting the pause button. It's just taking a quick breather, slowing down after a big push upward. Don't overcomplicate it. Don't go into a deep dive about why it's happening. Instead, laser focus on what really matters. The patterns. In this exhaustion phase, you'll see strong bearish candles, those red ones, pushing lower but still respecting the overall trend, which is up. Now here's the next move. We're watching for indecision. This is where the market is basically saying, I'm not sure what to do. And guess what? This indecision shows up as candles that tell us the selling pressure, those bears, is starting to weaken. That's right. It's your signal that momentum might be ready to flip and the trend is about to pick back up in the upward direction. And then it happens. Boom! You see a strong bullish candle explode onto the chart. This is your moment. Look at it closely. It's got a big push to the upside and there's a wick rejection at the bottom. What does this tell us? It's simple. The bears tried to push prices lower, but they failed. The bulls came in strong, flexed their muscles, and drove the market right back up, closing with confidence. And that, my friends, is pattern number 1. You're looking for that exhaustion, the indecision, and then the strong bullish push that tells you, yep, the trend is back on track. How simple was that? The second pattern you're going to focus on when the market's trending upward is what we call market exhaustion. Now, what does this mean? Well, after a solid move up, the market starts to slow down a bit. It's like the market is catching its breath. So during this phase, your job is to spot these wick rejections. You know, those little wicks on candles? These wicks show us when the bears, the sellers, are trying to push the price down, but they're running out of steam. And guess what? The bulls, the buyers, are coming back strong to push the market back up, aligning with that overall uptrend. So this is your second pattern you're looking for when the market's heading upward. Now, let's flip things around. In a sell-biased market, when the market's trending downward, you're going to look for similar signs, but everything's in reverse. You'll see the market pushing down, but just like before, the market will enter that exhaustion phase. In this case, you're going to spot those strong bullish candles. They're going against the downtrend, trying to push things upward. But hold on. As those bullish candles show up, you'll see indecision candles follow, meaning the buying pressure is running out. And what happens next? The bears are getting back in control, and that push-up just isn't going to last. This signals that the market is going to continue its downward trend in line with the bears. Next, let's zoom in on what happens next in that downtrend. When the market is moving strongly to the downside, we're still in that exhaustion phase. But now, we're looking for multiple wick rejections. These wicks tell us that bullish pressure is trying to push things back up temporarily, but the overall bearish trend is still holding strong. The bears are taking control again, and that's what we're waiting for to confirm that the downtrend will continue. To wrap it all up, there are 4 key patterns you need to focus on. 2 of them are for a buy-biased market, uptrend, and 2 for a sell-biased market, downtrend. These patterns are all about market exhaustion, recognizing when the market is pausing and spotting the price action that shows the trend is about to pick up. Master these patterns and you'll be one step ahead, able to ride those trends and increase your chances of making successful trades. Alright guys, We're jumping straight into 2 live examples in the market. I'm going to break this down step by step, so make sure you're paying attention because this is where the magic happens. First example, look at this 1 hour time frame chart. Boom. You can see it clearly. The market is pushing up, higher highs, higher lows, higher highs, higher lows, and higher highs again. This is a solid uptrend. It's crystal clear that the market is moving to the upside. So what are we going to do? We're going to wait for the market to break the previous high. Once it breaks that high, we want the market to pull back to this level, showing us strong bearish pressure. After that, we look for some indecision candles, and then we wait for that bullish candle to confirm the continuation of the trend. Boom! That's where we get in. Let's keep this train rolling. The market keeps pushing up, just like we're seeing now. Yes, the market is coming back to this level, and now we've got that indecision we've been waiting for. What's next? We need to see a strong candle pushing upward to confirm we're on the right track. Now, you might be asking, why should I only take a trade if I see indecision candles followed by a strong bullish candle moving up? That's an awesome question. And here's the secret. Never take a trade unless you spot both of these confirmations. Why? Because the market needs to clearly establish a level showing us it's actually committed to continuing the bullish trend. When you see indecision candles holding above the support area, that's the market telling you, hey, I respect this level. And that, my friends, is what we call confirmation. And if there's no confirmation, there's no trade. Period. Now, let's break it down using our chart example. For those of you who've been trading for a while, when you spot that second indecision candle, you might recognize it as a double bottom, a classic reversal signal. But hey, if you're new to this, no worries at all. Just think of it like this. The market is establishing and respecting a level, and when it comes back to that level and holds strong, boom! That's an even stronger confirmation that we need before entering a trade. So once that second wave kicks in, what do we see? A strong bullish candle pushing upward, perfectly aligned with the overall trend and bouncing off that retest level. This is where you scale up your trade size. Why? Because at this point, your probability of success is significantly higher. It's all about stashing the odds in your favor. Now, I won't go too deep into the nitty-gritty of exact entry and exit points or how to time your trades of perfection. That's a whole other discussion for another time. But what I do want you to take away from this is that you need a solid strategy and a risk management plan that actually works. Backtest it, forward test it, keep refining it until you get consistent results. And one last thing, risk management is everything. We always stick to a 1-2 or 1-3 reward to risk ratio because that's how we maximize profits while minimizing risk. So now let's play this trade out and see what happens. Boom! Trade number 1 smashes right into profit. This pattern is massive, and I mean massive. We're just getting started, so now let's dive right into our second pattern. Alright, buckle up because we're diving into the second pattern. On the hourly time frame chart, you can't miss it. The market structure is shouting downtrend. Just look at this. The price is pushing down, pulling back, pushing down again, then exhausting. Over and over, it's crystal clear that here's the big question. Does this look like a buy bias market or a sell bias market? Come on. The answer's obvious. It's sell bias. Everything about this structure screams that the market is heading down. Now, the next move is simple. Find the level where the market is reacting, but hold up. Don't jump in right away. We're not taking the trade yet. What we're doing here is waiting for the market to pull back to that level. Why? Because we're looking for the pattern to develop. And patience? Oh, it's your superpower. Just let the market do its thing and return to that critical level. Now, here's where the magic happens. When the market revisits that level, you're hunting for multiple wick rejections. These wicks are like neon signs flashing. This is a valid level. And the best part? It's all in line with the downtrend. Check it out. Here's your first wick rejection. But don't stress about finding the perfect pin bar or some ideal setup. That's not what we're doing here. Instead, focus on building confluence, stacking reasons to take this trade. So, let's break it down. You've got your clear downtrend, you've identified a key level, and now you're seeing wick rejections confirming that level. This is your green light. Let's go time. Take the trade. Now, I'm not going to deep dive into exact entries or exits because that's your job. Back test it, forward test it, own it. The main thing is understanding the flow. You're trading with the trend, spotting a break of structure, waiting for the retest, and using those wick rejections as your signal. All right, let's roll this forward and see what happens. Boom! Example number 2 hits take profit. That's what I'm talking about. But listen, I need to be real with you for a second. When you go back and test this yourself, not every trade will be as picture perfect as these examples. Why? Because yeah, these are cherry-picked examples. But that's the point. This is what you're aiming for in the live market. Here's the deal. Most traders, they rush into every break and retest based spot. But the great traders, the ones crushing it, they wait. They hold off until the best, cleanest setups show up. So even if these examples were handpicked, this is your blueprint. Wait for clear structure. Spot the break of structure. Watch for the retest. And confirm it with strong candles or multiple wick rejections. Stick to the plan, stay disciplined, and you'll be trading like a pro in no time. Alright guys, let's hit those key points one last time. Be patient. Don't rush. Wait for that retest. It's the secret sauce to trading success. Stick to the 2 patterns we've covered today. No distractions, no overcomplications. And risk management. It's your golden ticket. Protect that capital like it's your life savings. Plus, don't forget to backtest at least 100 trades per pattern. I'm telling you, this step is an absolute game changer. Now, is this video dating even a tiny bit of value? Smash that like button, annihilate the subscribe button, and hit that bell icon so you never miss the next drop of Trading Wiz. Guys, we're building the smartest trading community on YouTube, and you're a part of it. Until next time, stay disciplined, stay focused, and let's absolutely dominate these markets together. Take care, everyone. Let's go.